Even in an AI-focused world, MacroEdge is in the business of focusing on you. We don't just understand our clients, we listen to what's said and illuminate on what's not. In a world moving at the speed of light, with shifting markets, evolving workforces, and non-stop disruption, MacroEdge helps you to navigate and identify novel opportunities, expand your enterprise, and succeed in tomorrow's world. And it all starts with you. Put your enterprise and your perspective in the driver's seat. We're in the business of you.
Good evening, everyone. Welcome to MacroEdge Radio number 70. This is John Galt speaking. I'm going to start this show off before I bring our guest on with a quick commentary. We haven't had much to say since the beginning of the war. I'm just going to highlight some points from a Middle East geopolitical point of view as everyone falls into the room. Number one, what we're witnessing was easy to predict. Bob McNally warned about this on 60 Minutes. Many other analysts who are experts on the Middle East warned about this. General Kane warned about this possible outcome. What are we warning about? Everyone forgets about the 12-day war. Everyone thought because President Trump said we took out their nukes, that everything was hunky-dory, that was the end of it, we'd never come back. Unfortunately, most people didn't analyze that the key to the Iranian mindset was, one, they already had enough fissile material to sit there and manufacture 6 Hiroshima-sized warheads, which are not terribly complex to make. And number two, their ballistic missile technology has improved dramatically. But since the 12-day war, their technology has improved dramatically. Their ISR has improved. They now have the assistance of not just the Russians, which has been highlighted, but the Chinese. So they're getting real-time targeting data and the ability to hit targets in boxes that they were not able to prior to this conflict. The bigger issue is this. The Ayatollah, the old bastard who was killed in the first day of the war, had an opportunity to sit there and just pick a moderate and fade into history as some sort of weird, freakish hero, but we made him a martyr. We're going to pay the price for that because they decentralized their command and control structure. We knew this was a possibility, yet we ignored the advice of experts on the Middle East and in the Pentagon who said, if they go to a decentralized command and control structure, they would be able to strike for months, if not years. Now we're witnessing the consequences of rushing into a war without thinking about the other alternatives and assuming that the Persians are the Venezuelans. If anyone thinks that the Persians are the Venezuelans, raise your hand and go ask Crassus. Without further ado, from Bison Insights, I have Josh Young coming on board here, and for some reason it dumped him as a speaker, so we'll bring him back up. What you're going to hear tonight is what's happening in the energy space. It is a nightmare. And by that I mean every aspect of nightmare that so many energy analysts have warned about. You witness what is happening to the markets today, and you have to understand that we're seeing a bottleneck of 20% of the world's energy. Okay, fine. No big deal, right? Except for one thing. We're also seeing a bottleneck in things like naphtha, fertilizer, sulfur, helium, etc., etc., etc. And the consequences of this bottleneck, for whatever reason, is not been recognized by our government or the European governments yet, but it will be eventually when inflation hits hot and hard. And for some reason, Josh, I'm trying to bring you up, and it is not allowing me to complete this invite.
Here, I'm up here already, I think. Can you hear me?
Okay, good. We got you. Now I got you, sir. Welcome aboard. For some reason, it was delayed, and I don't know why. Well, please, before we crank it up, we always want our guests to talk about their book. And by that, I mean, tell everyone more about bisoninsights.info and what you've been bringing to the discussion on X, which has absolutely been fantastic analysis and a keen eye as to where the energy market is now and where it could possibly be going.
Okay, great. Yeah, thank you. And I might actually have a different view on sort of the setup for all of this, which we can get into at some point. But so I have a day job, which is I'm the portfolio manager and chief investment officer for Bison Interests, which is an exempt advisor here in Texas. And as a part of that, I've invested in oil and gas companies on the public equity side for the last 11 years. And then last year, after the Liberation Day sell-off and sort of real sort of gloom in the oil market, I decided to launch Bison Insights, which is a newsletter where I have the opportunity to share more of my one-off investment ideas and investment theses in a sort of controlled, walled environment, in addition to sharing some additional analysis on oil and gas macro.
Well, let's start from today and move backwards. And by that I mean we've heard a lot of noise today. As we speak, we've got oil sitting at we'll call it $95 a barrel for WTI, 103 for Brent. This is not earth-shattering prices yet, but for every week that we see this so-called bottleneck persist, the failure to open the Straits of Hormuz, what are some of the projections that you're seeing? We're hearing everything from $150 to $200. That's the big headline grabbing crap. But in reality, where do you think this could be headed if we go 4 to 6 weeks as the initial projection, and then the worst case scenario of 8 to 12 weeks?
Yeah, I mean, I think it's really, I guess I'm going to be subject to the analyst speak of it depends. And in this case, there's a few real possibilities either direction that could send oil price up by, let's say, $2 a day from the start of the blockage, or mostly blockage of the strait, to as high as potentially $5 a day from the start of that. And then also, my initial thought on all this had been, hey, let's track this using WTI oil. And I do think that WTI oil will eventually rise roughly in line with how much global prices have risen, but we've already seen a dramatic increase in oil prices for oil coming off the coast of Oman outside of the strait. So we're already in $150 to $170 oil price territory for oil delivered there. And the simplest explanation is that there's a whole bunch of oil tankers that right now are stuck either inside the Persian Gulf laden with oil and products, or just outside of the Gulf waiting to get in through the strait in order to pick up stuff.
It's not really they're stuck. It's more like the insurance companies have set the rules. And I think you would agree that most people don't understand how insurance works on ocean-going vessels, especially tankers. When you're talking a VLCC, a very large crude VLCC, you're talking tens of millions of dollars of ship, not including product, that could be blown out of the water with a $50,000, a couple $50,000 missiles. It does not make sense for them to take those kind of risks without some assurance. And the problem is you can't replace the crews either. So where do you see it heading if everything is diverted to the Red Sea? Because at this point in time, it doesn't take but 1 or 2 lucky shots a day to sit there and keep this paralysis ongoing.
Yeah. So again, I think just my starting point on this might be a little different from how you're framing it. So on the insurance thing, I think there's sort of these different items that folks have gravitated towards that are, let's say, precisely wrong. So they're easy to measure and there's an aspect of truth to it, but everyone sort of just, it's like a magnet. Everyone just sort of like jumps to it because it sounds good. And again, you can sort of validate aspects of it. And so the insurance story, frankly, like the Trump administration did this too, where they sort of jumped to that and they said, hey, we're going to fix this. The reality is that the current cost, ostensibly there's insurance available for these tankers to go through the strait, and it's about $5 million, about 5% of the ship value. And the problem is not that there isn't insurance available. Apparently, it's still being written. The problem, because the value of crossing right now, the difference in between that oil that's bottlenecked at, I don't know exactly what the benchmark price is. I probably should have checked it, but probably ultra low. sort of COVID era lows for oil that's stuck in the Persian Gulf versus just outside of the Strait, being, let's say, $150 a barrel. So if you're able to take oil and make $100 a barrel margin on it by doing a single day or whatever journey, then a 5% cost for insurance is not going to be the barrier for it. But since you mentioned the Red Sea, I think that's one of the big potential dividing points in terms of whether we're going to see radically high oil prices or whether this could, to the extent that the war doesn't last for years, that where this could be sort of a less extreme event. And that's what happens with the Houthis. And if the Houthis start attacking oil tankers to block the southern end of the Red Sea, that would potentially be environmentally catastrophic and also could be sort of a further shock where you go from, let's say, a 10 million barrel a day disruption right now to something closer to 15 or even 20.
There is a history of the Houthis hitting Yanbu and attacking the terminal, nothing substantial, of course, during the war between Saudi Arabia and the Houthis in northern Yemen. It's interesting to note that their inability to sit there and really, or willingness to take it out, is different compared to where we are now versus where we were 5, 6, 7, 8 years ago. If we see such an attack, or an attack by Iran on the East-West pipeline from Ras Tanura to Yanbu, what kind of immediate consequences would you think we would see, not just on the Middle Eastern oil market, but that would reverberate through Brent and, of course, New York rather quickly?
Yeah, I think that would be sort of a triggering point where you'd see this price for the Omani crude at 150, 170, where you'd see WTI oil trade close to that, and where you could actually see the reason I was saying that I think that the prices may level out to some extent is, one, I think you'll start seeing some of these tankers pull away from that area and start shipping oil from places where it's actually available. And as that happens, you'll see them move very quickly, and you'll see debottlenecking, at least of available supplies. And so to the extent that there is oil available from the Houston Ship Channel, I think you'll see that the price of that just level closer to the global price minus the shipping cost, and that shipping cost should actually come down quite a bit. Again, we'll see subject to various items. So that would be, I actually don't think the Houthis need to attack Yanbu. If they just block, I forget the name of it, but the strait that's essentially connecting or almost connecting the Arabian Peninsula with Africa, which is a much simpler task and very achievable, that would be enough to shut off most of the oil coming out from the west coast of Saudi Arabia, because there are severe limitations of oil transport through the Suez Canal and through the pipeline that bypasses the Suez Canal.
Well, the Bab el-Mandeb is a blockable situation, but I think more so hitting any kind of Red Sea, any carrier in the Red Sea, like you said, would be enough to trigger massive panic in markets. My question is, that leaves the Suezmax as the only vessels that could clear, because there's a difference, folks, between a VLCC and a Suezmax. I'll defer to our guest to explain that. But the larger carriers that come into the Persian Gulf and to Yanbu can't pass through the Suez Canal, thus limiting the volume and the size of the vessels that can make it through there anytime. And that really would trap not just the vessels in the Red Sea and the Persian Gulf, because then they're not available elsewhere in the world. But wouldn't that have some major implications on supply to Europe, in my opinion? Because what the hell are they going to do? They're not making enough oil in their continent for this. And we sure as hell can't export enough if we start taking all of these tankers offline.
Yeah, I mean, there are some real problems and real questions. One thing that's worth highlighting on this, getting back to the intro, just for one thing, Europe is going to have real problems, especially the industrialized portion of the continent, and then non-China Asia especially East Asia, is going to have real problems, also due to limited supplies. And Australia is going to have issues. Apparently, Australia imports a bunch of diesel from China, and China has suspended their diesel exports, which is going to be very odd when you think about it, because Australia exports a bunch of commodities to China. That's what they use their diesel for the most part. So China is sort of hurting themselves in an unsustainable way. But the big thing I think that might be different in our views on this is that this actually doesn't hurt, at least doesn't necessarily over time hurt the US economy, in the sense that there's an oil shock where consumers having to pay more definitely hurts, and it definitely goes through and impacts inflation. But because we're a net exporter, and because oil is very capital and labor intensive and is a very large employer, albeit smaller these days after terrible layoffs and a big bad downturn over the last almost 12 years, there's actually potential upside for the US economy from all of this. Maybe not for tech stocks, and maybe not for the US stock market, but for the real economy, I actually see substantial potential upside, which may be a factor, by the way, despite what the Trump administration says. When you look at what they're doing on a number of different economic fronts, I think there may actually be an understanding of potential significant economic benefits and sort of rearrangements from a international alliance and trade relationship perspective, from the reordering that's happening as this energy crisis plays out.
Yeah, I think the bigger issue we're going to see in the United States is distillates, and that's coming from my logistics background in trucking and shipping. We're going to see a problem, as we've seen globally, with bunker fuel. Look it up, Google it, at your friend folks. Diesel, et cetera, as we just discussed. Diesel is going to become a major issue because, for whatever reason, and this is a mistake of the first Trump administration, we really didn't accelerate refinery building between 2016 and 2020. And does that or does that not present a risk of the very shortages of the base fuels that we need, jet fuel, diesel, et cetera, to keep the economy moving through this crisis?
Yeah, I think it's sort of a like open debate in terms of crude quality and refining capacity. I agree. I think that the Trump administration's war on the oil industry was misplaced, and it should have been a push along the lines of what they've been doing with critical minerals for more development in the U.S. and then much more refinery building, expansion, and improvement. That being said, the U.S. refining base is enormous and highly economic and highly advantaged. It was advantaged even before the war because of low cost inputs of natural gas. And so I don't know that we'll have any real oil products shortages here in the US outside of California, which frankly was on track to have its own energy crisis because they basically forced the shutdown of almost all of their local refineries. But excluding California, I think the US is actually pretty well positioned, and maybe also Hawaii, just because it's an island, whatever. I think we'll be okay. I think it'll be okay in terms of diesel availability and so on too. Maybe the prices will be a little higher, but just in the historical context, people were excited about diesel getting to $5 a gallon. Diesel was also $5 a gallon almost 20 years ago. And so in the context of the various things that have skyrocketed in price, diesel being a little bit more expensive, yeah, it'll flow through the economy to some extent, but it really had just lagged too much, and we had sort of over benefited from this lag of increase in price in diesel previously. And I think I would frame it more like that. And again, just the US refining base is very large, and along with the Canadian refining base and Canadian heavy oil and now Venezuelan heavy oil, I think the US is actually very well supplied with relevant oil and products. And I think, when you look myopically just at the US or the US and Canada, we're a big net winner out of this whole mess.
Do you see our refiners taking advantage of these spreads and exporting more of their refined product, thus driving the prices up higher inside the US?
Yeah, for sure. But if you think about it, the same factors that have temporarily held the WTI oil price down are also keeping domestic refined product prices low because the ship prices for now are so expensive that you need to essentially deduct the cost of shipping between the delivered price versus the versus I guess the pickup price or whatever it's called, the loading price here in the ship channel or along the Gulf Coast. And so I think there will be over time, to the extent that this continues for months or longer, there will be certainly higher fuel prices here in the US, but in terms of fuel availability and then also in terms of economic impact, the direct impact, and there will be lots of secondary implications, right? Like there being real economic problems in East Asia and parts of Europe because of insufficient energy supplies already. And there being flight cancellations and there being all kinds of other issues. I mean, these are going to indirectly affect the U.S. economy. They're going to hurt U.S. exporters of various products, although unfortunately we haven't been exporting that much. We've been running this large trade deficit, but there will be negative impacts, but not. I would not expect fuel shortages here. I would not expect extraordinarily high energy costs. And if anything, this whole crisis could end up leading to a similar situation to what we're seeing with natural gas, where the US is a hugely advantaged consumer of natural gas for various chemicals, industrial processes, power, et cetera, because of our abundant supplies. And so you could end up with almost a two-tier market where you have US and Canada sort of well supplied with higher prices than we saw before, but relative to most of the world, actually much lower prices, depending on how it plays out.
So with that being said, do you think that, well, let's just take one quick thing because I want to address this quickly for people who will ask. One, Keystone, one of the most classic blunders in American history. If we had built that pipeline, this probably wouldn't even be up for discussion as a major issue. Would you agree with that?
I mean, there's been lots of unfortunate infrastructure issues. Fortunately, Canada did get their TMX expansion done last year, which is helping support Canadian oil prices. But yeah, there should have been a lot more infrastructure built, both to the coasts in Canada as well as to transport more oil from Canada to the U.S. But right now, there's actually excess capacity between the TMX pipeline and then also the rail capacity to get from Canada down to the U.S. Gulf Coast at a quite moderate price, relatively speaking. You're talking roughly $15 a barrel to use a crude rail car, essentially, to bring the oil down, and that's really moderate considering the potential, well, the real dislocations we're seeing right now globally, but also the historical dislocations that we've seen. So I actually don't think that in particular is a huge issue right now, but the bigger issue is that because Keystone wasn't built, because of some of these other delays and insufficient infrastructure development, Canada is producing a lot less oil than it would have been otherwise. And I think the US is a lot better positioned from an energy security perspective when Canada is producing more and when Canada is more interconnected with the US than less.
I 100% agree. At what price level? And I'm talking sustained, and that you and I understand this. Just I understand it from an investment perspective and watching the pipelines, et cetera. At what price point do we start seeing the shale industry reopen and expand again? Right now, there's sort of just stasis, playing wait and see from what I'm seeing in the statistics, which is all I have to follow. But what are you hearing with your ear to the ground without revealing anything from your newsletters?
Yeah, sure. No, I'll try to speak pretty open. I think the one thing I'm not going to talk about is specific stock names for this, which I think sort of helps from a compliance perspective anyway. So we are seeing rigs getting added already. The rig activity level in the US had fallen to calamitously low levels. First, the regulatory extremes of the Biden administration started to bite, along with lower prices towards the end of it. And then the Trump administration jawboning down oil prices, threatening huge supplies from foreign sources and various other sort of nonsense. Really, you can see two major legs down in US oil drilling activity. And so that trajectory was such that we were going to see significant declines in U.S. shale oil production, crude oil production, and then potentially even declines in U.S. natural gas liquids production. And so we need probably another 30 to 50 rigs running, drilling oil and liquids rich wells here in the US just to avoid a pretty bad decline in 2026. So we saw, it looks like there's about 8 rigs that have been added in the last couple of weeks. And it looks like there's probably going to be another, I don't know, probably 5 rigs a week to the extent that we see oil prices over $90 a barrel. And I think it's a question not just of the spot price, but also the forward curve has started to rise. And so the producers are able to, using the futures market or using a hedge provider that leverages the futures market to go sell oil out 6 months out, a year out. And when this started, 6 months out, oil was, let's say, $60 a barrel, and now it's closer to $75 a barrel. I didn't look at it today, but let's say somewhere in that range. And so the difference in between locking in 60 versus 75 is enough to bring some marginal fields into being more economic. And I think we're going to see that back end rise more, both from the SPR exchanges that the Trump administration is doing, where they're giving out oil now, but you have to give them back more oil than you get, let's say 2 years out, which is, again, raising the curve further out, which is smart, actually, I think, from a policy perspective. And it's reducing the strain on the market today, which is massively undersupplied because of the Strait of Hormuz crisis. And so as we see that back end price rise more, producers can lock in a higher and higher price for the incremental oil they'll bring on through adding rigs. So I would expect, let's say, if things just continued how they've been going for the last few weeks, I would expect, let's say, 5 rigs a week to get added, maybe more if you saw sort of a bigger jump than we've seen very recently.
That's good to hear. Now that brings us to the next part, the delivery side of things. Would this be the ideal time? The Congress isn't going to do anything because they're idiots. The ideal time for the president to use his emergency powers and those port cities, those states willing to allow pipelines, expansions, branches, etc., for export and domestic purposes to be accelerated from the oil fields. Because let's face reality, Florida has finally added pipelines into its natural gas stream. It's been a huge project here for a decade. We really need more export points, especially on the East Coast, if we're going to take advantage of the LNG boom that we could profit from while the Middle East is under reconstruction.
Oh yeah, I mean, we've just been talking about oil. The natural gas situation is even more dire globally, and is even a bigger advantage that we have here. I think it'd be wonderful to see more pipelines built and more LNG export facilities permitted and built. There have been some pipeline issues that should get resolved by the federal government. Like, for example, there's not a pipe from Pennsylvania to Massachusetts, which is really important because Massachusetts imports liquefied natural gas in the winter, and which is just stupid and wasteful. And there's essentially still, let's say, $3 gas in Pennsylvania, and too frequently, there's $10 gas or $8 gas in Boston. And so, the cost of the pipe would mean maybe, if you had a reasonable build cost and reasonable permits, which is a stretch maybe, but it should be like 20 cents or 30 cents or something for transport for that sort of short distance. So yeah, that would be wonderful. I think the thing that the Trump administration could do here that could get a lot more rigs running and get a lot more production going is something similar to what they've done on the critical mineral side, where they either set a local floor price for local production, which again, the Trump administration they've been very hostile to the U.S. oil industry, weirdly. But if they change their approach that would be one thing that could actually be quite effective at inducing incremental supply. And then the other thing they could do that they're also doing with the critical minerals industries is they could essentially provide some sort of incremental funding to improve the economics. So whether it's interest-free loans, which they're doing, whether it's equity investments, which I hate, but they're doing, or whether it's some combination of tax abatement, tax incentives, certain other things, which they do all the time with unreliable alternative energies. They could redirect that. And so I think this would be a good, so it wouldn't solve anything today, but I think that sort of thing, even for producers that weren't benefiting from a specific policy like that, flipping from being ultra hostile and punitive to the U.S. oil industry to being supportive, I think would be a big, it would make a big difference, and could get a lot more local supplies going over the next couple of years.
Excellent. And this real quick break here, folks. MacroEdge.net, MacroEdge.net/Ozone. We bring these programs and our guests to you to sit there and provide information. Go to MacroEdge.net/Ozone. Get your 2-week free trial. Get the latest and more advanced macro analysis and economic analysis. We try to take a different approach and broader look at the information that's out there and not just accept the status quo. MacroEdge.net. Josh, I'm going to bring this up to you real quick, because if I were the dictator of the country, I would love to have a situation where did I lose the signal here?
No, I can hear you.
Hello? Okay, good. I was worried about it for a minute there. My microphone didn't show that it was on. I was going, what the hell? Okay.
Yeah, the technology's not 100% there, but it's still pretty cool to be able to have a radio show.
It is pretty cool with X Spaces, but it's not as simple as it was in some cases 20 years ago when I did this. It's weird. We look at the situation. You would think that making investments in strategic minerals or miners, and also oil producers or pipelines, you would want to make an exemption on dividends for 5 years, 10 years, to encourage investment. You would want to put an incentivized program versus the government investing with your dollars and my dollars. It would seem more logical. And I don't understand why we're not seeing more intelligent, creative methods for doing this. It is a bit frustrating. I have to agree with you 100% there.
Yeah, it's just some of this stuff is really odd, and it's not even a question of theory. We know how these different approaches work over time because there are many different countries that have tried many different approaches to induce increased activities in capital-intensive industries, cyclical capital-intensive industries, and you can just look through the historical set of countries and policies and see what the impacts are. So it's a little uncomfortable to see folks say the right things and then make unforced errors from an economic policy perspective.
Well, let's take your expertise in the industry and dismiss one of the myths that Venezuela is going to suddenly ramp up to 3 million barrels a day overnight. Would you please explain to our listeners and those who are unaware the devastation that socialism or neo-communism, whichever phrase you wish to use, has wreaked on the Venezuelan oil infrastructure and economy is beyond the imagination of most Americans. I used to have some friends who worked in the oil industry down there, and they would tell me stories in the early 2000s that would blow your mind.
Yeah, I mean, I think the resource is there. There's absolutely a giant amount of oil there. There might be even more recoverable oil in Venezuela still than there is in Alberta and Alberta's oil sands. And I've been very skeptical of OPEC reserve numbers or OPEC spare capacity numbers, but Venezuela has a lot of oil in place. But unfortunately, Venezuela has robbed American companies, and Western companies twice. And when you nationalize stuff and steal everything illegally, even if you do it once, it becomes extremely hard and takes decades for companies to recover their trust and come back. And Venezuela did it twice. And that second time really is tough and it takes an extremely long time and over the top economics for companies to come back. And what you're seeing right now is that the only companies coming back in are ones that already, like Chevron, somehow magically was able to sustain their operations in Venezuela when 100% of their other Western competitors didn't. So I think that on its own should merit some inquiry. But what's happened there is that after the sort of second round of nationalization, after Hugo Chavez became the communist dictator of Venezuela and imposed very radical economic and social and whatever policies, you saw an industry that had already been in decline and had already seen significant talent drain and brain drain go into just collapse. And so you have pipelines that have huge holes in them. Almost a lot of the compressors, the machines that essentially push the oil along, heat it because it's heavy and thick and needs to be heated and needs to be pushed along essentially in order to get it to flow. Those machines have been fully removed or had their parts removed or just rusted into oblivion. There's environmental catastrophe. Weirdly, the Western media, I'm probably too critical publicly of this stuff, but they get real excited about very small, minor things. Like they went and found a few natural gas wells in rural Pennsylvania that hadn't been capped properly. And they got real excited about this one water well, or sorry, this one oil well that was spewing a little bit of brine in the middle of just absolute wasteland on the very edge of West Texas. And they ignore that Lake Maracaibo in Venezuela is basically this like absolute toxic waste dump from all of the catastrophe of the Venezuelan national oil company. So anyway, just specifically, there's a huge amount of money, a huge amount of time, and lots of liability and lots of weird legal questions, as well as real safety concerns for companies trying to operate in Venezuela. So it could happen, and actually the Hormuz crisis and the Iran war could be an impetus for significant change in Venezuela beyond what we've seen. You could see the U.S. More directly either seize Venezuelan oil fields or send U.S. troops down to sort of secure them and then provide more financing or something else. You could see more direct involvement, which would accelerate the recovery. But without that involvement, you're probably not seeing much more oil production from Venezuela for many years. And even with the announcement that Chevron, I think Shell is coming back in small size, even with those announcements, maybe you're going to go from a little over 1 million barrels a day to maybe 1.3 million barrels a day, let's say, which is a very small amount of incremental production, maybe over a couple of years. So really a lot of the noise and the excitement, it's wonderful that Maduro was removed. Very weird the way he was removed, but wonderful. Life is better in Venezuela for the Venezuelan people and probably for the people in the region because he's gone. But it's sort of a pipe dream in terms of the concept that Venezuela would get to 3 million barrels a day of production anytime soon without much, much more radical intervention. And even then, probably like a 5-year process and hugely expensive to get a lot more oil out of there.
Fantastic answer, sir. Thank you. And by the way, folks, if you question this, ask yourself this. Why haven't you seen American and European oil companies rushing into Nigeria and Angola, pouring billions into those economies? The same reason you haven't seen it in Venezuela. You cannot trust the governments to be stable enough to guarantee the security or functionality of your investment. That's just reality. So that brings us back to the war situation. The proverbial twilight in the desert question. What a great book that was at the time. Little did we know that it would be a war that could trigger this, right, Josh? Is this a problem if this war lasts into June for the ability of the Middle East countries to bring it online by the end of the year? Because the damage seems to be multiplying on a daily basis exponentially. A lack of ability to make necessary repairs and maintenance also increases. not to mention the ability to import the parts and necessary people and expertise to maintain everything that's going on there. It seems to have a weird multiplying effect that no one talks about. I'm sure you're going to have some thoughts on this, but we see this lasting into June, July. It starts to become critical for the long-term viability of many of these countries' oil industries, does it not?
Yeah, I think it's a great question, and again, it's complicated. I think for about a third of the local production, it matters a lot, which is obviously very significant because of how much production is there. But the Twilight in the Desert was right. These fields have gone into decline, and there's a lot less production at Guar and some of these other supergiant old fields that Simmons correctly analyzed would decline. What he didn't analyze correctly or didn't sort of include was that they would go and hire a whole bunch of high spec drill ships and what do you call it? Various other high spec offshore drilling equipment and some of the world's best geologists and geophysicists and so on, and go and drill way deeper, way more expensive fields than they had ever drilled in Saudi Arabia and elsewhere offshore. And so those more complicated discoveries and deeper and higher pressure fields are actually much less susceptible to the issues that you're sort of implying, and that I think are real, which is when you look at some of these very old fields, if you shut in water floods and shut in sort of tertiary recovery schemes, you have a lot of risk in terms of what they look like when they turn back on. But I think that's only true for a portion of the production, and I think what you're going to see is that to the extent that the Red Sea remains open, which I really hope it does, because even though I'd make a little more money, it's going to be potentially a real problem for the world. But if the Red Sea stays open, Saudi Arabia, for example, could continue to produce from some of these old fields while shutting in some of the newer fields where there's going to be a lot less reservoir damage. I think Kuwait's going to have some more issues, Bahrain for sure, UAE, it's complicated depending on how much oil can get out of Fujairah, and then Iraq as well is going to have some real issues if they can't get their oil out. So yeah, I think for a portion of the production, there's going to be real issues, and again, it really depends on what happens with the Houthis and whether or not they get involved and to what extent they get involved.
Well, there's definitely some incentive for Indonesia to finally get their act together and start drilling more. That's for sure. Uh, it blows my mind that they have squandered everything the Dutch built for them and not expanded their oil fields. I'm really shocked by that, because they could take a major seat at the table, and they haven't done it, which is beyond any explanation. Do you have an explanation for it? I'd love to hear it.
Sorry, for which country?
In Indonesia. They have the infrastructure. They had the infrastructure. They could have jumped way ahead of everyone else if they had their.
That's actually complicated.
It's mind blowing.
They might not have as much oil as you're thinking. I mean, they could probably do a lot more exploration, but maybe the one that's more mind blowing to me is the UK, where they still have, what is it, like an 83% excess profits tax going on. That's basically killing their North Sea oil industry. And so right now in Europe, you have this catastrophic energy crisis that's cascading. You have natural gas at close to $20 an MCF. They normally measure TTF in megawatts, not per MCF, but the equivalent of in the US, it's 3 or 350 or so an MCF. So radically almost 10 times as expensive. And then they're suffering from even higher oil prices than we are, and potentially those will go up a lot, and then similar potential shortages of refined products, and they still have their excess profits tax, and they're still crushing their oil industries. So before we throw stones at Asian countries 10,000 miles away, we can throw stones at Western countries with policymakers who are Western trained economists who are choosing to not produce necessary oil that's discovered, that we know about, that could, with relatively low effort, come online. and they just rather kill this industry that they perceive as evil than get some incremental production. So between the two of those, I'd criticize the UK way sooner.
Well, they're able to tilt at windmills now, so that's a great function to replace the oil industry. Don't even ask me to touch that one with a 10-foot pole. I don't understand that. Europe is a lost cause, and it really blows my mind that we're at that point in time where they can barely field a navy and an army, and now they've given up their advantage in the Brent and North Sea. It just is astonishing, for lack of any other terms. So let's look at some of the current news that's occurred today. We had a refinery blow up in Tabasco, Mexico. Not a major player, but more production going offline. But when you see the news tonight, and I don't know if you've heard this, but BP has locked out their employees at Whiting, Indiana. And I don't know if that's going to help the situation, especially in the Midwest. Any quick takes on that?
Yeah, that's interesting. I didn't see that yet. I guess I was helping put my kids to bed before this, so I was going to catch up on the news. That refinery has had all kinds of issues. I actually didn't know that BP still owned that refinery. Maybe they tried to put it up for sale or something at some point. But that refinery has had significant issues. That was extended maintenance there had caused heavy oil prices to collapse in Canada in 2018. They've had various issues there. Really unfortunately, some of the organized labor stuff in the U.S. has gone from productive, let's say 100 years ago, when there were tons of workers dying on the job and there were real, just unfair, unsafe labor conditions, to the current situation where I know a number of folks who work at refineries here in the Houston area, and they get treated great. They get paid six figures. It's a little dangerous, but relative to many other similar skill-intensive quasi-industrial jobs, I mean, it's quite a good job in my view, and quite competitive to get those jobs. So that sounds more like a sort of Detroit style legal issue than a real problem for the company. The real problem, let's say, because of mismanagement or something by the company.
Yeah, I agree with that. I think this is a pure play by the steelworkers, which actually are the representatives for them. And this is stupid at this point in time. Let's go on strike during a war, so we'll win the public over. Brilliant move, guys. Give yourselves an A+ for that one.
Yeah, sorry, real quick on that, doesn't that put them up for, I mean, again, it's not officially a war, but I would think that they would still, I think we might still be under Trump declared an energy emergency or something like that last year. So I'd imagine that wouldn't go over so well with the National Labor Board. And, I wouldn't expect that to be an issue on a sort of anything more than a week or a few weeks sort of basis.
If they're smart, they'll go back to work tomorrow because Trump can order them back to work and end this quickly under the emergency powers he has. That's for sure, because it doesn't seem to make sense. California shot themselves in the foot, letting Valero walk because they wanted to sit there and extort the company. You talked about California. You talk about these other areas. It doesn't seem to make any sense that they think that we should have a nationalized oil policy when the state-run systems have been much more efficient for price discovery. And here we are now with the southern United States, and I'm biased, I live here, but if you look at that band from West Texas to North Carolina, it's a hell of a lot cheaper than it is in the Northeast and far West. And it's all because we were willing to allow the development of the industry versus assigning these false boogeyman mentality that they're the cause of all kinds of crazy things, which have been disproven for over 100 years.
Yeah, I mean, actually, since we mentioned California, there's one thing going on there. I've written about this extensively at Bison Insights, and I've opened up some of this stuff publicly. California the governor very openly, wants to be the next president, is trying to get nominated. There's all kinds of disasters. There's this big expose on fraud there. But there's one thing, I mean, terrible leader, but very politically astute. And what they've been doing is they crushed the California oil industry. Drilling activity in California collapsed. There's great wells to drill. There's fantastic fields. They're sitting on billions of barrels of oil that we know about that is actually not difficult to access. And then they destroyed their refining industry. What they've done is, I think they did some of the same analysis that I did in terms of the Trump administration's claims to drill, baby, drill, but actually being ultra hostile, sort of inappropriately, bizarrely hostile to the US oil industry. And what they did is they started to award significantly more drilling permits after essentially granting zero over the last several years. They started to grant, I think they've given out 2,000, or they have a mandate to give out 2,000 drilling permits this year. And they've been talking about doubling that, and potentially continuing that on a multi-year basis. And so what's happened is that as the overall US onshore oil drilling rig count has fallen by about 20 to 25% from when Trump became president to, let's say, a month ago, the drilling rig count in California has actually doubled from very low levels, and it may increase substantially from here. And so I own stock in the one publicly traded company that has drilling rigs active in California. So full disclosure, that's my bias, but I own it partly because I did this analysis, noticed how, again, it's evil, right? Because they destroyed this local industry. They've jacked up the gas prices in California. But here they are leveraging that. And what they'll show isn't going to be Newsom's destruction of the California oil industry from when he got into office. What they're going to show is from the time that Trump got into office, the California oil rig count doubling or tripling, and the US oil rig count, at least for the first year going into this now sort of manufactured energy crisis, they're going to show this, the broader US onshore oil rig count down and the California rig count up a lot. So again, it's sort of brilliant, but also sort of evil.
Very, but I think it's all for show, like you said. Let's go into the byproduct issues, because I think a lot of people don't understand that we see 20% shut in the Persian Gulf, but byproducts are ignored. Fertilizers have been getting a lot of attention lately, especially nitrogen-based fertilizers. Helium, byproduct of natural gas production, and my big one, sulfur, which is used for processing metals and mining. You see those items, those big three right there, and you have to ask, is the impact going to be more of a first world, aka European impact? Because like you said, we can provide that in our own hemisphere. But Europe is not as fortunate because they killed their own oil industry and their own byproduct industry. You see that occurring, and you have to start asking, who are the winners and losers in the big picture? Let's start with Europe. What's your take on their future right now, at least for the next 6 months?
Yeah, so some of this stuff I know really well, and some of it I know much less well. So the sulfur and sulfuric acid access implications are a little outside of my area. I've read about it, but it's not an area of expertise. Oil and natural gas, and then the sort of direct chemicals that the chemicals industry are converting oil and natural gas liquids into and gas into, that I think I understand a lot better. So you can look at just the chemicals industry in Europe and this collapse of some of these fantastic, very old facilities that had received huge amounts of investment and were optimized for all kinds of different things. And in some cases, they were just completely disbanded. In other cases, and scrapped. In other cases, they were chopped up into big pieces, shipped over here to the greater Houston area, and then along the Gulf Coast, and then rebuilt here. And then in one or two cases, I think those companies they discarded their European chemicals plants, and then just built brand new chemical plants here on the Gulf Coast. So Just purely from this one step removed from the oil and gas industry, there are these huge industries. They were employing at least tens of thousands, if not hundreds of thousands of people in Europe. And many of those jobs are lost. And then many of the jobs adjacent to them, so the, trucking and supplying and the food and just all the different aspects of those high employment industries are gone to some extent. So that's just an area that I know really well because that's where the NGLs are going. All this other knock-on stuff like you're mentioning, it's going to be a real problem. And then also fertilizers, big natural gas inputs, big mined commodity inputs, and very energy intensive, and similar problems where there could be fertilizer availability issues. The one aspect that I think I might have a little bit of a variant view than what folks are saying right now, and I think you see it a little bit in the price data recently. I actually don't think there's going to be food shortages, and I don't know what will happen to food prices, but I'm hesitant to say that I think like the soft ags are going to go up a lot in price, just because what you see when you look at what happened with the Russia-Ukraine situation. When Russia invaded Ukraine, everyone freaked out. There were some folks that became really big from selling newsletters on, doomers like, hey, stock up your cupboards and whatever. And with a small amount of price incentive and a small amount of flex, the US and Canada, and to a lesser extent Brazil and Argentina, whatever, produced way more wheat and corn and soybeans. And then next thing you knew, prices had completely collapsed. So I think we're well positioned, and I think like the soybean crop, for example, just based on the recent price moves and some of the news I've seen, there's great harvests. So we might actually be okay on the food side. But it won't be great if you're a European farmer and you can't afford fertilizer, and you're not going to feel great that some American farmer or Canadian farmer was able to increase their yield by 20% just by planting more and by using a little more of whatever, and took your market.
Absolutely, sir. I appreciate all your time here, and I'm going to sit there and hit with one question because we talked about the investment perspective, and now we have the SEC coming out with this proposal to end quarterly reporting to biannual or annual reporting. When you look at that from the perspective as a fund manager, investment manager, and this is divorced from your individual investments, this is more of a generalization. Does that make you more or less skeptical of the data you're getting from the companies, or more concerned that it opens up the market to more opaqueness and less transparency so we can make accurate investing decisions?
It's a great question. Yeah, I'm not a big fan of that rule change. I do think philosophically, corporate America is too focused on quarterly earnings and should be more focused on longer term success rather than managing quarterly numbers. But that's not the same thing as not wanting there to be quarterly numbers. And my advice to anyone running a public company or on the board of a public company would be to just keep reporting quarterly numbers anyway, because I think there will be a set of companies that continue to report on a quarterly basis in a detailed manner and continue to have audits and just to have all of essentially pretend like there isn't this rule change. And I think the companies that display good governance and good reporting will be rewarded with richer valuations. And I think it's unfortunate to see this, because I think a lot of the deregulation that the Trump administration has done has been fantastic. And I think that generally speaking, we were way too far. I mean, your name is real John Galt, which is great. I think we went way too far in terms of regulations and government intervention and so on. But having good property rights and having good law enforcement on property rights that's efficient and effective is a key to a successful capitalist system. And so I view accurate financial reporting with consequences for inaccuracies, which unfortunately those have sort of fallen away to a large extent over the last number of years too. I view them as key to a functioning financial system. And then also when you look at various markets around the world, markets where there's accurate reporting and high governance standards and high consequences for relying on numbers and other stuff like that, tend to get rewarded with much higher valuations, all things being equal, than markets where there isn't that sort of good reporting, good governance standards, and significant consequences for failure to adhere to those consequences. So I happen to, most rule changes that reduce rules, I'm in favor of. This one in particular, I don't like, because I think it actually, unfortunately, sort of gives up or gives away one of the big advantages that U.S. capital markets have.
Josh, thank you for this past hour. It has been fantastic. You are a great guest. Please come back again. Maybe when the dust settles, if it settles in the Middle East, we can talk about the consequences and future investment opportunities. Tell everybody where to find you on social media and about your blog one more time.
Yeah, absolutely. Yeah, thank you very much for having me. I really appreciate it. These are some great questions and perspectives. So bisoninsights.info is my blog. It's on Substack. Come check it out. I share a bunch of ideas of companies that could make a lot of money if oil prices go even higher than than I hope they do. And also, I run an investment firm. None of this is meant as investment advice, and none of it should be relied upon. And you can find stuff about my investment firm at bisoninterest.com.
Thank you once again. And everyone, Friday night, March 20th, buckle up. Just Dario returns, and we're going to talk NVIDIA. We're going to talk CoreWeave. We're going to talk about the chip laundromat, the macroeconomy, what's happening in Asia, and get a firsthand perspective on the war from the European perspective. For MacroEdge.net /Ozone for your 2-week free trial, this is John Galt speaking. Good night now.